Good morning, folks, and welcome back to Almus Market Mornings. The geopolitical soup is something that keeps boiling, whether it's the threats or the proposed toll or withdrawal or the proposed toll against investments from the Middle East. It's all something that keeps evolving. And now, for a change, US CPI data was on the forefront after it indicated declining consumer prices in June and for the first time in 6 years. The headline numbers fell month on month, but excluding food and energy, it was broadly flat. The data coincided with Chair Warsh's testimony to the Congress, where he reiterated quite strongly that the Fed has no tolerance for high inflation. Let's understand all this from JK. Morning, sir. How are you reading into the CPI and the testimony? Has there been any paring down of rate cut expectations post these two events?
Good morning, Swaraj. Yesterday, a lot to chew upon for the markets, and yeah, definitely the focus was on CPI inflation data as well as Kevin Warsh's first testimony to the legislators. Um, you know, Consumer price inflation for June was considerably softer than expected, and obviously the gasoline prices falling 9.7% contributed a lot. But there are also other sectors that came a bit lower. And the largest component within the CPI, the shelter, also rose just 0.1%. So the encouraging aspect of the report was that the breadth of the softness in price pressures was broader. So that actually gave some comfort to the market. And in the core side, while overall it remained broadly unchanged, but the month-on-month it was 0.17% if you go into the higher decimals. So that means it's a run rate that is required to bring the inflation down to 2% year on year. But it's all very ambitious thinking because we are not seeing significant drop in the inflation. So this is a good report, but then whether it remains consistent, particularly in view of the renewed tensions in the Middle East, that we need to really see, how it impacts monetary policy. But definitely, markets being what they are every day, they keep changing their expectations. After this report, July rate hike has been pushed out of the window. September still remains, but there's only going to be only one hike instead of two that was expected by the market earlier. Now, whether Kevin Warsh gave another, more inputs to the market, that was not to be. He said all the right things, being vigilant, prepared to take action, and to ensure inflation returns to target, making sure the inflation surge will be a thing of the past. All these things, he said the right thing, but no forward guidance. These are general principles on which the FOMC or the Fed works. That's what he said. And of course, he did also say, importantly, what he would do if Trump tried to interfere with the Fed. He said he would continue to do his job. So that, I mean, you can read whatever you want to do from read from it. Even the Q&A session was not too different. Maybe some people read it as a bit hawkish. He avoided giving any clear signals to the market once again. Now, with that, not providing much to the market, we look ahead to his second part of the testimony today. Yesterday it was to the House Financial Service Committee, and today it will be Senate Banking Committee. So we'll see whether anything new. But it definitely, he also reiterated that yesterday's CPI report did not change the overall picture much, and that is when the markets also reacted less, or rather retraced the initial reaction to the news. Of course, before these developments, we also had some sort of a reversal in the oil price, which had hit $87 on the Brent, but it came back to around 83 levels. Consider it as a profit taking because it risen too high. President also later reversed his threat of a 20% fee on the cargo shipping through the Hormuz Strait as the US battles to break Iran's hold on the waterway. He said it would be replaced by massive trade investment deals with the Gulf states just hours before the US resumed its blockade on the Iranian port. So don't read it as a relief. I think we still continue to have the uncertainty whether the strait would be open for free shipping or not. So those are the things that we had to deal with yesterday. Of course, the currencies reacted negatively, or rather positively, rather dollar negatively to a soft CPI number, with a resultant fall in the yields, as well as commodities recouping some of their losses. However, dollar continues to hold above the key support of 100.50, which was the earlier resistance. Middle East uncertainties continue to play on the minds of the traders, and any flare up. The fear is that if any further flare up, 90 could be seen or above for oil, and that will keep the yields elevated. And as of now, the yields are holding above their key levels, like around 4.20 for the 2 year, well above 5% for the 30 year, and around 4.60 for the 10 year as well. So 30 year is at 5 and above. So that keeps the dollar well supported. Maybe we look ahead to, as I said, second part of the testimony by Warsh, and as well as PPI data, which will be published tonight as well. Dollar should be ranging between 100.5 and 102, broad range, digesting all these triggers. Yen continues to be the weakest for its own domestic issues, and Chinese yuan the strongest among the currencies. Now, that has been the trend for quite some time. Yesterday, we had the Chinese trade data, which showed that exports accelerated, at the highest rate since October 2021, rising 27%. So China is in a sphere of its own. That's why the yen yuan is also been strengthening. Other currencies are still respecting the that range that we have been seeing quite so far. I think no major triggers except for the data that we'll have tonight and Kevin Warsh. Otherwise, I think no nothing great to move the currencies out of the current higher range where they are moving. For rupee, we had another inflation report yesterday. The WPI almost touching two-digit at 9.87% from 9.68% in May. It is the fastest increase since September 2022, mainly caused by increases in food prices and surge in oil prices has gone to increase the retail. I mean, the companies faced higher import prices for oil as well as. While CPI is not a benchmark that RBI tracks for their monetary policy decision, it is definitely tracked as it gives a sense of pipeline inflationary pressures. There's also a bit of update on the FCNRB, where there's a lot of focus on how much the banks would be able to raise in terms of new deposits. So far, the data indicates about 10 to 11 billion has been mobilized, and there has been some encouraging indication that a person connected with the discussions with the government stated that inflows around 80 billion could be expected through these channels, but that looks very ambitious, at least going by the responses and the indications that we have got so far. Meantime, the crude basket for India also jumped about $8 barrel in the last 10 days, even as the benchmark crude prices went up. So again, that puts some sort of a pressure on Indian economy as well as the markets. But yes, one good thing is that having faced the crisis of since the March very well. Now this time around, we are well prepared. As per reports, we are well stocked and also well diversified in terms of import sources. So that's not, at least unless things do escalate beyond a point and then continues for much longer, I think we tide over this situation once again. So we have the rupee now well settled above 96. The whole of day yesterday traded above 96, and of course, we did have some intervention around 96.30 levels. 96.30 is also a Fibonacci retracement level of the big fall we had from 96.96 to 94.10. That could hold for some time. Not that it is going to reverse from these levels. A reversal in sentiment for the rupee requires a much larger trigger, and right now nothing much is visible. Only thing we could say is the FI flows have been positive. this month, quite positive actually. Around 3 billion we have seen compared to what we had seen over the last several months. So, but that's not enough to turn the rupee because we have enough demand to absorb those supplies as well. So await currency markets, I think, not changing their direction in a big way. Rupee, yeah, though it has weakened from 94 levels to 96 levels, I think it could also stall for some time. We have to wait for next big developments to get a direction. Thank you.
Thank you, Jack. And yeah, well, on the inflation front, it seems that it was a softer print with the June's number, especially if you look at the core side. The inflation was more or less flat, and the breadth of the inflation, as Jackie mentioned, it was softer. So all across, not much of a price rise, and that is something markets took hands down. July Fed rate hike expectations has now been pushed out, at least for now. And even if you look at the testimony by Kevin Bosch, it didn't provide any forward guidance. He himself said that, CPI is just one data point and not reading much into that. But he remains an inflation hawk and said that high inflation will be a thing of the past. But otherwise, we saw a bit of reversal in oil prices from 87 to $83 per barrel. President Trump also announced the 20% Hormuz toll to be replaced with investments by the Middle Eastern countries. The market reaction of the dollar index fell post CPI. Currencies still broadly, well, it's still dollar index still remains above its key level. The yields are also holding out the key levels. There was some sort of a reversal, but we are not out of the woods yet. For the rupee, we traded comfortably above 96 the entire day. Some good positive sentiment would be required to actually turn the tide for the rupee. As of now, even if CNRB, it is raising some money, but I think a larger sort of push would be required to shore up the rupee. That's it from us today. Thanks for listening. We will catch up tomorrow with a fresh round of updates.